Now, I have a little problem with Jeff because he said Don and Mike have some interesting things to talk about. So that, that's putting a little bit of pressure on us. So how many folks have been here more than 10 times, been to this seminar more than 10 times? How many people think they've been here to every one? Anybody? I know we have at least one. Gary, put your hand up. Come on. Anybody besides Gary think they've been here to every one? For the most part, we cover federal and state tax update just about every year. So this is something that I seem to talk about just about every year. So I pretty much know what my topic is going to be next year, right? Federal and state tax update. The question is, if I look a year forward from where we sit right now, what am I going to be talking about at that point? Right? We have an election, right? We have an election coming up. Has anybody seen that? There is an election coming up, right? And if you recall, 3 years ago when the last election happened, I had all I had my entire presentation figured out, knowing exactly what I was going to talk about based upon the polls. And on Wednesday morning, Wednesday morning I woke up and I turned my phone on and I'm standing in my bedroom and pitch dark and it's black. It's dark and I pick up my phone and the first thing I said was, oh, crap. And it had nothing to do with the election. It had nothing to do with who won, who lost. It had nothing to do with that. It had everything to do with the fact that I had to completely change my presentation in less than 36 hours because I was on stage the next day talking about, tax laws and what's going to happen, what we think is going to happen. So who's going to tell me, and I don't want you to tell me now, maybe after, tell me what I'm going to be talking about next year. A year from now, what am I going to be talking about? Am I going to be talking about 4 more years? And with 4 more years, with President Trump, am I going to be talking about the tax reform 2.0? Is that what I'm going to be talking about? Or am I going to be talking about a Democrat going into the White House? And what are we going to be talking about right there? What are President Warren's expectations with respect to tax law and the changes that may happen? What about if it's President Clinton? Is that still a possibility, right? I think Donna Forley just fell off of her chair back there. Yeah, so many things. We think it's important to be talking about things. Have we had significant tax changes in 2019, new legislation? Not really, but we're still working on tax reform, right? For the first 20 years of my career, we talked about tax reform is going to come. It's going to come. It's going to come. It's going to come. Then it did come. President Trump pulled out tax reform, which was passed in December of 2017. Most significant changes in nearly 30 years. It was out there, and they were talking about it being simpler. Was it simpler? Was it easier? How many people found that their 2018 returns were simpler than their prior returns, 2017? Anybody found them simpler? Okay, so for a lot of people, it was simpler. For a lot of people, it was easier as compared to prior years, and things were easier to follow. Now, the majority of those people are, just your blue-collar folks, your normal, person out on the street. But for a lot of the people we work with, and a lot of people in the room, it was more complex. Well, why was it more complex? Well, it's because we have more difficult business decisions. We have more difficult issues that we're talking about and trying to deal with all the time. And, we're always trying to plan around what we think our interpretation of the law is. So a lot of changes constantly coming. A lot of things we're constantly thinking about. So is it going to get easier for tax professionals? Nope, it's not. One thing we can pretty much guarantee is the tax law is always going to change. Okay, and it's always going to become. It's not going to get easier for us. It's going to be complex. And one thing I can definitely guarantee. At the end of every busy season, at the end of every tax season, if you talk to any tax professional, they're going to tell you this was the worst busy season ever. We heard that at the end of 2019. And I will tell you, we heard it at the end of 18 and 17 and 16. The longer we spend, the older we get, the harder it is. So I guarantee you're still going to hear that. It was the worst busy season ever. But we may never be able to really say that it was worse than 2019. 2019 was really the perfect storm with respect to difficult tax seasons. And why was that? Why was that the case? Well, we had tax reform. We had the most significant tax package in 30 years, effective 2018. So there are a lot of changes that were made. A lot of new things we had to learn. And we felt we learned it. We felt we knew it pretty well. And we did. We knew it pretty well. but there were a lot of things going into that tax season that were not expected. One, we had a 5-week government shutdown in early 2019. Well, that certainly didn't help anything, right? Because not only did we get off to a slow start, we were already behind. Whether we needed to talk to the IRS because we had a power of attorney issue or we had an audit or just asking general questions. With a 5-week government shutdown, it was very hard to make progress. Brand new tax law, brand new tax forms. They completely redid the Form 1040. New forms, new instructions, new regulations, hundreds and hundreds of pages of regulations, new changes, qualified business income. Nobody had ever heard about that before. Brand new for tax year 2018. So we had the perfect storm. One of the most difficult things for us as a firm that we had to deal with was the fact that everything got to us later as opposed to prior years. So if I had a return that I normally would have been signing on February 1st, this past busy season, it was probably 2 weeks later, because the information coming from banks, brokerage institutions, K1s, everything was late. Everything was much later than before. So you had this buildup, this slow buildup up to March 15th, and we look around like, holy crap, there's a lot to do between now and April 15th, and we still need information. So it was really the perfect storm going into that tax season. And what happened? It was very, very busy for everybody. Not just us. It was very busy for everybody. Every CPA that I've talked to, they will tell you that it was the toughest for a number of different reasons. So what do we have to look forward to going forward? Well, there haven't been any significant, I'll call significant tax changes since busy season ended, since April. And with the elections very much in progress, and with our politicians doing nothing but being out there campaigning, we don't anticipate there are going to be any significant changes between now and the next busy season. So what do we need to do? Well, we need to pay attention to what the new tax law says and basically perfecting it. And there are things we can do, things we're talking about, and constant things that come up that we say, okay, what if we do this, this, or this? A lot of it's interpretation. What if we change some things? So we're consistently thinking about what we should be doing going forward. From a tax point of view, one of the most important things that we've seen with our clients has nothing to do with federal income tax or state income tax. It has to do with this concept of sales tax and this Wayfair Supreme Court case that was settled in June of 2018. That's a very, very big deal, because if you have a business, you're doing business in states other than your home state, other than Pennsylvania, or other than your home state, you're doing business. Even if you're just shipping goods to California, you're shipping goods and selling goods in Illinois, you now potentially have state tax problems that you didn't have before. And Mike's going to spend at least 20, 25 minutes talking about that Wayfair case and how significant it is for our clients. And it is very significant for our clients. And we're talking about it all the time because it is a big deal. And it is definitely a situation where if you're not paying attention to it, you can really, really be in some deep trouble at some point once it gets caught. So let's talk about tax reform a little bit and how it affected us so far in 2019. So what do we need to know going forward with respect to tax reform and how it affects us going forward? A couple things. First off, individual changes. There were a lot of individual changes. They're all temporary, okay? At the end of 2025 is the last year that those are effective. And so in tax year 2026, they will sunset and we go back to the old laws. Same with this pass-through deduction, the qualified business income. It is temporary to sunset at the end of 2025. And then business changes, most of the business changes are permanent. And when I say permanent, all I mean is they're going to stay the same unless there's a change, unless Congress changes them. But at the end of the day, there's nothing really permanent, right? So what happens, 2021, we have a Democrat in the White House. Let's assume that. Dawn, it's okay. You're okay. Assume we have a Democrat in the White House, and Congress is controlled by Democrats, both the House and the Senate. A lot of these things that we're working through right now, a lot of these things are probably going to change. You can probably expect the corporate tax rate to not be 21% if the Democrats are in control, right? Now the corporate tax rate is 21%. Part of tax reform is reduce it from 35 to 21%. That's not going to be the case going forward if the Democrats are controlling the White House. So anytime I'm talking about tax changes, there's nothing that's permanent. Everything can be changed, and there's a chance that things are going to be changed in the future depending upon what happens a year from today. A year from today, we'll know a little bit more about what we're looking forward to in the next couple years. So let's talk a little bit about individual things, and this is just a rehash of some of the things that went through with respect to tax reform. As far as the individual changes, the majority of the changes are things that are after adjusted gross income. So total income, for the most part, is not changing compared to prior years. It's a similar situation with not very many changes. Most of the changes were after that, like itemized deductions, significant changes to itemized deductions. Prior to tax reform, about between 30 and 35% of Americans itemized. After tax reform, it's somewhere between 8 and 12%. So a significant number of Americans who were itemizing before are no longer itemizing. Part of that is because the itemized deductions, there were changes, so your itemized deductions were significantly less than the prior year, and the standard deduction was doubled. So now the standard deduction for a joint return is $24,000. So that removes a lot of individuals who were formerly itemizing, so they're no longer itemizing before. Also, the personal dependency exemptions and deductions are gone, and that was replaced by a doubling of the tax credit for some, and more people were getting those. So, was that good or bad? Well, it depended upon your situation. A lot of people weren't getting those deductions anyway. And then the last thing, the 20% deduction on certain pass-through income, that's the qualified business income. That's that concept that we mentioned, and I'm going to spend a little bit of time talking about that. This is probably the most complex area of tax reform, is this qualified business income, because there are just so many different places you can end. You can start down this road and end up over here and say, oh yeah, I get the deduction. You can start down this road and you end up over here. It's like, no, I don't get the deduction because of A, B, and C. So it's fairly complex in the right situation, but in the right situation, it's fairly simple. And part of the reason that they needed to put this 20% deduction in is because they were looking at small businesses. And if you think about it, if you're reducing your corporate tax rate from 35 to 21%, and your corporate tax rate is 21%, you can't have small businesses who are pass-through businesses paying tax at a rate that's significantly higher than that. And if this wouldn't have been put in, you could have had situations where people were paying 39% tax on flow-through income, trying to compete with C corporations that are paying 21% tax. So that's the primary reason it just got put in. The reason for qualified business income deduction are two things. They want to give small businesses tax deductions so they can compete with C corporations on a level playing field. And you want to give companies that are employing a lot of people a tax deduction. Small businesses and people in pass-through businesses that are employing a lot of people. So that's pretty much what the qualified business income does. Let's go back to that one real quick. A couple important things that I want to talk about, the changes to the itemized deductions, just stepping back a little bit. Two significant changes on the itemized deductions that cause a lot of people not to itemize anymore is the change to the deductibility of state taxes. So the maximum amount of state taxes you can deduct going forward is only $10,000. So in prior years, it was unlimited. So, if you lived in a high-tax state like New York, Democratic state, California, Democratic state, Illinois, Democratic state, those states who have very high taxes, a lot of those individuals end up paying a lot more tax because they no longer get the tax deduction because the state tax is limited to $10,000. That was significant. And the other thing that was fairly significant that I saw with our clients is the miscellaneous itemized deductions is no longer, it's no longer there. So a lot of people who were deducting brokerage fees and getting big deductions for brokerage fees, a lot of my retired clients, a lot of my clients who are elderly, they were getting big deductions for brokerage fees. And people who were employees, but they traveled a lot, and they took tax deductions for all of their non-reimbursed business expenses. Those are completely gone now, which is a big hit to a lot of consultants. I'm sure there are a lot of consultants out there. I call them consultants. A lot of people who are employees, but they're traveling business people. They spend a lot of time on the road, and they deduct a lot of those costs, or they have a home office. In a lot of situations, those deductions are gone if those people are employees. So a couple of other important things on the individual side that I just want to mention. The first one is the importance of qualified charitable distributions. Okay, a qualified charitable distribution is very important. And what this is, it's the ability for somebody who's retired, somebody who's over age 70 and a half, who's required to take required minimum distributions out of their IRAs. Okay? So, for our parents, a lot of us may have parents or grandparents who are in that situation. You need to think about whether this is something that they should be doing, a qualified charitable distribution. Let's assume grandma gives $10,000 to her church every year, and she has a required minimum distribution of, let's just say, $75,000 a year, because she's pretty old, right? She's pretty old, so the rates change. So she's got $75,000 coming in every year. And that $75,000 coming out of the IRA is taxable as ordinary income. She has a couple different options if she wants to give money to her church. She can give money directly to her church, write a check out of her checking book and give $10,000 to the church. She gets a charitable deduction for it. But guess what? Grandma's probably not itemizing anymore. So since grandma's not itemizing anymore, she's really not getting a tax deduction for that $10,000. The better option is to have grandma link up with whoever she has the account with and have them make that charitable contribution directly to the church. So what we just did is that $75,000 now becomes $65,000. So we just reduced grandma's tax liability, and grandma's all happy and she makes us meatloaf. That's kind of how that generally works. You make grandma happy, she either makes you meatloaf or a pie. Either one is pretty good. Second bullet point, AMT still alive on the individual side, not super relevant anymore. I would say that in years past, 35% of my clients were in AMT, maybe 40%. In 2018, for 2018 tax year, I probably had 5 total clients who were in AMT. It was very small compared to before. So it's still relevant, but it's still there, but not really relevant. Let's skip down to alimony. Alimony rules changed in 2019. So anybody's getting divorced in 2019, you can no longer deduct the alimony, and it's no longer picked up in taxable income for whoever's receiving the alimony. The old divorce decrees that were before that are still relevant, still in place. You can still deduct them. One of the things that I found interesting, I read an article I just saw two days ago. I've got it sitting right here. It's from one of the tax magazines I read, and it says alimony tax gap swells to $3.2 billion. Holy crap! $3.2 billion. What does that mean? So I read the article, and basically what it says is the IRS. They know they have a difference between what people are deducting and what people are reporting in income, but they have no idea how to fix it. And this article goes on to talk about in 2010, this tax gap was maybe half of that. And in 2017, when they did the study, it swelled to $3.2 billion. So it kind of tells you where the IRS is. The IRS, I mean, this is pretty simple. Figuring this one out is pretty simple. If I deduct alimony on my tax return, I've got to put the Social Security number of my ex. So all the IRS has to do is say, okay, Mr. Johnson's deducting $50,000 of alimony. Social number of the ex-wife is this. We should be able to go to that return, and there should be $50,000 of income. That's pretty simple. They have no idea how to track that. So it tells you a little bit about where the IRS is. I mean, that is very simple. At $3.2 billion, and they think that the underpaid tax is somewhere between $250 million and $750 million, which is ridiculous, right? I mean, it should be a simple fix. I'm thinking about just doing a proposal, sending it to the IRS and say, listen, for $100 million, I can fix this for you. It's not that big of a deal. It cannot be that hard. Changes to tax-free transfers. I just want to mention the estate tax exemption is up to $11.4 million, which is a big deal. So there's definitely a lot of planning around how you should be planning for estate taxes. And this is for your wealthy people. Hopefully your grandparents are in this position, or possibly your parents. Hopefully they're in that situation, because it's probably going to benefit you at some point, hopefully as long as you're a good kid. But there's a lot of planning that can go into this, because there are a lot of savings opportunities here. A lot of estate planners will tell you that if you pay estate tax, you're a meathead, because there's so many ways to plan around it. And if you start early, you can certainly plan around it. Pennsylvania EITC matters. I just threw this on here because I think it's important I actually have several clients who do this. These are clients who give money to Pennsylvania schools. You know, some of them are Catholic schools, some of them are Jewish schools, you know, some of them are just Christian-based schools. And there are tax credits out there that Pennsylvania will allow you to take. And it's a home run. So let's assume that I give $10,000 a year every year to Bishop Canevin High School. No matter what happens, I graduated there, I'm going to give money to that school. I didn't, but let's just assume I did. So I give $10,000 a year to that school every year, no matter what. There's no reason not to use the EITC program. I can get a 90% tax credit and save $9,000 of Pennsylvania tax. So I've had several situations where I talked to potential new clients that said, listen, you're giving this money to school. You hire me, I'm going to get you 90% of that money back. And it's pretty much a home run, especially in situations where people are already giving money to those types of schools. Okay, let's talk a little bit about the qualified business income deduction. And one of the things to keep in mind is what I said earlier, is the reason they wanted this qualified business income deduction is because they wanted small businesses to be able to compete with the C corporations that are paying tax of 21%. So you can get up to a 20% tax deduction on qualified business income. And it's somewhat complex, you know. In some situations, it's somewhat complex. Do I qualify or don't I qualify? Maybe I don't qualify. As far as this past tax season is concerned, there were some issues with the qualified business income, simply because since it was the first year, it was difficult for people to comply with all of the disclosure requirements. The disclosure requirements were significant, and there were a lot of things that had to be disclosed. And one of the problems with qualified business income deduction is the IRS didn't have all of the forms ready and completed before tax season, and they've just recently completed some of those forms. So it was somewhat difficult to comply. And a couple other things that were difficult is this concept of an SSTB. An SSTB, you know, is a specific service trade or business, which, the original law when it came out said some businesses do not qualify for the qualified business income deduction. And there's a fine line. You know, it's very easy for a manufacturer. For a manufacturer, it's easy. You're going to qualify. For an accounting firm, you don't qualify unless you're under a certain threshold, under a certain income threshold. So there were and still some gray areas, you know, kind of in the middle where you may or may not qualify for that 20% tax deduction. So just a little bit of a summary here. Only individual taxpayers can get this tax deduction, okay? And it's if you have income from a flow-through company. It's not taken at the entity level. It's not taken at the partnerships. Not taken at the S corporation. It's taken at the individual level. It's the entity that has to properly report and disclose everything to the IRS and to their taxpayers, to their owners. Okay, so a little bit about SSTBs. The QBI, the deduction, is not permitted for certain professions. And you see some of them listed here towards the bottom, right in the middle of the page. The accounting doesn't qualify. CPAs don't qualify. Financial consulting don't qualify. Law firms don't qualify. Most people in the medical field don't qualify. They don't qualify unless they're under a certain income threshold. Now, I'll tell you about that in a second. So this is an important slide as it relates to qualified business income. These are the limits for the qualified business income. So I'll tell you right now, the first bullet point, it says exceptions for taxpayers with taxable income below these thresholds. If your taxable income is below these thresholds, you qualify no matter what. You can be an accountant, you can be an attorney, you can be a doctor. If your taxable income, married filing joint, is under $321,000, you can qualify for this deduction. Okay? It doesn't matter if I'm a CPA. It doesn't matter. I can still qualify. And this is one of the things that was tough to figure out early on, because accountants all thought that they were out and didn't. You couldn't qualify. It all comes down to taxable income. And make sure you understand, it's taxable income, not total income. So I can have total income of $400,000 from Grossman, Yannick, and Ford, flows through to me on a K-1, and after my itemized deductions, as long as my taxable income is $321,000 or less, I can still qualify for this qualified business income deduction, and it's a 20% deduction. It is a big deal. The bottom figures that I have here is when it phases out completely. Okay, once you're over $421,000, you're not going to get it, unless there are other things that you qualify for, which I'll talk about. So, a simple example. Hey, Mike, what's our time? There's no time. The clock's not running. 10 more minutes? Okay. So here's an easy example. Let's assume Mike and I are partners, and we have K-1 income of $340,000 each. And this assumes that let's just assume we're a manufacturer. We manufacture widgets. And we're the two partners, and we both take home, our K-1 income is $340,000. We both get the standard deduction of $24,000. Mike's married. His wife is a school teacher at Baldwin. She makes about $300. That's about right. It's a rough school district, so, and she gets the whole summer off, so 300 is reasonable, I think. So taxable income for me is $316,000. I'm below the threshold. Taxable income for Mike is $616,000. He's over the threshold. So who qualifies for the qualified business income deduction? Since my income is below, I'm definitely going to qualify. So I get a 20% tax deduction on the lower of my taxable income before the deduction, or my K1 income of $340. So that gives me about a $63,000 tax deduction. That's real tax savings, right? That's going to save me $12,000 to $15,000 of tax. Mike, on the other hand, since his income is over that limit, doesn't qualify for two reasons. One, because he's over the limit, and he doesn't pass the wage test. There's a wage test out there. Remember, part of the reason they wanted to pass this is they wanted people who were employing U.S. workers to get a tax benefit. So since there are no wages, Michael doesn't qualify. Go to the next example. The only thing we're changing in the next example is the fact that there are business wages. So we are a manufacturer. We manufacture in the United States, and we have $1 million of wages. So because we have $1 million of wages, there's a different test. So now you have to look at this test to see if you qualify. So since Mike qualifies under this test because of the wages, he now gets a 20% tax deduction based upon the lower of his taxable income or the K1 income. So 20% of the 20% of the 340 gives him a tax deduction of $68,000. Now it's kind of interesting, right? Because we have two very different scenarios here. So the fact that under the first scenario, the fact that Mike's wife makes $300,000 a year kind of penalizes him with respect to this 20% tax deduction, which is kind of interesting, right? The hope was to help small businesses. But in this case, it really didn't help the small business, right? It helped Dawn because Dawn saved taxes, but it didn't help the other person, didn't help Michael. So a lot of agreements between partners are, if we have taxable income, we'll make a tax distribution out of the company. We'll take the cash out of the company so you can pay your taxes. But in this situation, you have an unusual situation because Michael's tax liability is going to be a lot higher than Don's tax liability. So it makes it a little bit difficult. And you have to think about, and a lot of it's going to come down to who's controlling the partnership. Because if I'm controlling the partnership and I don't want the cash to come out of the company, I'm not going to make those tax distributions, which makes it a little bit punitive for Michael. He's not getting enough money to pay his taxes. So it's kind of interesting in exactly how this works. There could be some problems between partners who are in this situation trying to determine how much money should come out of the company to pay taxes. The difference here is, let's assume it's an SSTB. Let's assume we're CPAs, right? We're CPAs at Grossman, Yannick, and Ford. Basically the same numbers. And since it's an SSTB, there are other things I have to think about. I only qualify if I'm under the $320,000 of taxable income, which I do. So I continue to get the 199A deduction, even though I'm an accountant, even though I'm a lawyer, even though I'm in a medical field or I'm an athlete, I still qualify. For Michael, though, since his income is over the threshold, he's not going to qualify no matter what. Even if we show you that we have qualified wages, the wages are still there, but since it's an SSTB, Michael doesn't qualify. And just very briefly on the wages, we showed that you had to have wages, and those are all wages, including owner wages. Any U.S. wages would qualify when you're looking at the wage calculation. So here's some shortcuts to determine if you qualify for 199A. And I think this is important when you're talking to your friends who are in business, and you're talking to them about their taxes. And I'm sure it happens at every cocktail party, right? Somehow tax talk always breaks out. So one of the things, the shortcut in understanding whether you're 199A, this is the shortcut right here. There's a taxable income test. If you're under the threshold, it doesn't matter what you do, you're going to qualify. So if you're under that threshold, you automatically qualify. Taxable income test number 2. How about if you're over the threshold? If you're over the threshold and you're not in one of those specialized service businesses, accounting, law, medical, if you're not in one of those and you're a manufacturer, you're going to qualify as long as you pass either the wage or the property test. There's a separate test out there. If you pay enough salaries, if you pay enough wages, you're employing United States workers, you're going to qualify. You could have $150 million of taxable income and still qualify for this if you have enough wages, if there are enough wages coming out of the company. Taxable income over the threshold and the business is an SSTB, you just don't qualify. And a CPA, Grossman, Yannick, and Ford making $600,000, they're just not going to qualify because it's an SSTB. So what can be done to increase the QBI deduction, and this, this is one of the things we've been thinking about and been planning over the last year and a half. How do we change QBI? First off, we need to pay attention to the limitations, because those limitations are very important. Because I could have a situation where I'm under the threshold, and then my wife comes home from work that day and says, hey, guess what? I just got a $100,000 bonus. December 31st, I just got a $100,000 bonus. And let's assume we're right at the threshold, and wife comes home, I just got a $100,000 bonus. Well, that's fantastic, but can we defer that another week? Because if we defer it a week, if we defer it into the next tax year, I stay under the threshold, and that's going to save me a lot of money, right? Especially if the majority of our income is from my QBI activity. By getting that extra $100,000, all of a sudden we're over the threshold, and we just lost a significant tax deduction. Same type of concept when you're very close to the threshold and you're thinking about going out and buying a piece of property. Or not, let me take that back. Let's assume you're $100,000 over the threshold. You're $100,000 over the threshold is December 31st. You're not going to qualify for the QBI deduction. What if you go out and buy a $100,000 piece of equipment? Buy a $100,000 piece of equipment, take bonus depreciation on it. Now I'm within the threshold. So what really happens there is that $100,000 that I'm spending on that piece of equipment, I'm getting an additional 20% tax deduction on it because I qualify for QBI. So you have to think about things like that. Can I play with my taxable income to change it so I qualify? And sometimes, I'm changing it simply by changing, fixed asset additions that I'm doing at the end of the year. Understanding your compensation and your guaranteed payments. Because if I'm a shareholder in an S corporation, any W-2 income I take out of the company does not qualify for QBI. But the flow-through income qualifies. So if I would completely eliminate my compensation, I just increased my QBI by whatever that compensation change was. Now, there has to be reasonable compensation. So I can't go from my W-2 compensation from $1 million a year down to zero. But under the right situation, I can go from $1 million down to $250, and I just created a $750,000 QBI deduction. Same thing with guaranteed payments for a partnership. Guaranteed payments for a partnership. If it's coming out as a guaranteed payment to a partner, it doesn't qualify for QBI. But if it comes out as flow-through income from the partnership, it qualifies for QBI. So at the end of 2018, we're talking to a lot of our clients who are partnerships and say, listen, your guaranteed payments are up here. If we changed them, put them down here, we just created $1 million or a couple $100,000 tax deduction, and we're going to save some tax dollars. Calculating QBI for multiple businesses, way too complex to try to discuss or even explain in this setting. There's a lot going on when there are multiple K1s and multiple businesses. So I'm not going to go into it. There's good information in our handout that talks about it. But that's where the majority of the complexity was with respect to busy season this year when we're talking about these things. If you get one K1, it's not a big deal. If it's a K1 coming from a manufacturing company, it's not a big deal. It's actually pretty simple. Excuse me. But if you get 12 K1s coming from some companies, some entities are SSTBs, some of them are partially SSTBs, and some of them are complete manufacturers, completely changes calculation. Like I said, the IRS, their forms weren't ready this year, so it was somewhat difficult to work through some of these because there were a lot of different interesting results. Let's talk about some business-related changes. And when I talk about business, obviously the QBI is business-related, but let's talk about just straight business-related changes. The first one's very important: simplified accounting rules for businesses, changing from the accrual basis to the cash basis. Under tax reform. After tax reform, a small business is now defined as a company that has average revenues of $25 million or less. We've got a lot of clients that have average revenues over the last 3 years, $25 million or less. So those companies, we were able to change from the accrual basis to the cash basis of accounting. So what does that mean? We're all accountants, right? What does that mean? Well, let's assume you have $3 million of accounts receivable and $1 million of payables. Under the accrual basis of accounting, your income is much different than if you're on the cash basis of accounting. If you're on the cash basis of accounting, you've got a $2 million add back or a $2 million reduction to your taxable income. So we just reduced taxable income by $2 million. Obviously, we understand it's a timing difference, but that's a favorable, very favorable timing difference if every year we see the trend that receivables are significantly higher than our payables. Michael had a client in particular, your steel company. What was your your adjustment accrual to cash?
It was over $3 million.
$3 million, a $3 million adjustment, a 1-year hit, because we know at some point it's going to reverse, but it might not reverse for 10 years. So, that's a huge adjustment. So we went from, with our tax planning with that client thinking that, okay, they're going to owe X dollars of tax. We just reduced taxable income by $2 million. That changes everything, okay? So something that definitely needs to be considered, accrual to cash. If you're over $25 million, you don't qualify. Bonus depreciation rules have been expanded. There's a 5-year window where their bonus depreciation is 100%. It's a big deal. We have a lot of clients who benefited greatly because of bonus depreciation. They will continue to benefit greatly. But it's something we need to be paying attention to, knowing that, as we get close to year end, does it make sense to go out and buy those assets so you can take the bonus depreciation on? If you know you're going to need them, it might make sense to do it. But you also have to be thinking about, how it ties into the qualified business income deduction. Interest expense limitations. There are now interest expense limitations, for companies that are highly leveraged. So if you're in that situation where you're highly leveraged, you could have a situation where you're not allowed to deduct all of your interest in a particular year. Now, if you don't deduct it in 1 year because you're limited, you can carry it forward and use it in a future tax year. So it's not a permanent deduction. It's just a temporary deduction that you need to be paying attention to because it could come back and hit you if you're unexpected. Okay, 1 minute, okay. Meals and entertainment changes. Entertainment, no longer deductible. So you're taking somebody to a hockey game, taking somebody to a Steeler game, paying for tickets. Those tickets are no longer tax deductible. There was a little bit of confusion about meals because initially we thought that meals weren't going to be deductible either, but the 50% meal limit is still there. It's still 50%. You can still deduct 50% of meals. So that's out there. And that was a little bit confusing when it first came out because it was just hard to follow what they were trying to get to. So let me pop forward here because I already talked about many of these things here. My clicker's not working very well. I think we might need a new battery in this. You have one? Okay, additional points to consider, net operating losses for C corporations. The rules have been changed there. So there are limitations with respect to net operating losses. You don't lose those losses. It's just there could be limits in how much of those losses can be deductible in any given year. Thing I'm going to cover there are tax matters related to M&A activity. As a result of tax reform, we look at acquisitions much differently than we did before. Like if I'm going to look at a company, I'm going to buy the assets of a company. I know now with bonus depreciation, if I'm buying the assets of a company, I can depreciate the hard assets. So if I spend $10 million to buy a business and there's $5 million worth of assets, in year one, I can take bonus depreciation on $5 million. That's a big deal. It completely changes my outlook on my ROI, right? Because in year one, I'm paying no tax, most likely, as a result of that acquisition. The other thing that's important with respect to M&A activity are state tax issues. As I go out and buy a company, now with the things that Michael's going to talk about in a second, now if I go out and buy a company and there's sales tax issues there, and there will be sales tax issues on almost every acquisition of a company, there's something that is way more important now than it was 10 years ago because the states are becoming very aggressive, which is the segue right to Michael as he's going to talk about Wayfair and the consequences of Wayfair to some of our clients.
Well, before I get into that, I just wanted to make one comment about the 199A. There's a landscaping company in my neighborhood. They drive up and down the street. The guy knows what I do, and he had some questions on his tax return, so he said, would you meet with him and go over a couple of things? So I did, and believe it or not, on his 1040, right where he would be eligible for the QBI deduction of a few $1,000s, there was a 0 on there. His return was actually prepared by a CPA, so it's kind of frightening. Hopefully that person's not in the audience here today. All right, moving on to state sales tax. Just just as a general announcement, I don't select the topics for this CPE event. I feel like I do talk about this. Maybe this is for the third consecutive year, but that ought to tell you what Don thinks about this. Is, you know, he selects the topics, and he feels very strongly about this. So much so that a few months ago, I went to him and I said, "Hey, I need an exemption for this year to get out of speaking on CPE Day because, you know, my daughter wants to go to this Disney Junior dance party at Heinz Hall tonight." He said, oh, no, we can't. You have to speak. Everyone has to get their sales tax update, so we need to make sure this is a topic. So I put together his priority list. It's 199A, sales tax, and then a distant third is Mickey Mouse. So, but I found out last night that we're short one ticket, so I'll be around till 9 o'clock tonight to talk about sales tax if you want to. All right, other than the QBI deduction, there's really no bigger topic out there right now than the Wayfair decision. And there isn't a week that goes by where I don't get some question about this. And I figured I'd start off with just a little story to tell you how we've come to where we're at right now. Years ago, I could remember my neighbor who worked for the same company as my dad. It was a big international corporation, and they had offices all over the place. And he would order a particular item. I don't know exactly what it was, but instead of getting it shipped to his house, he would get it shipped to the location in West Virginia, the business location in West Virginia, personal item. So every time my dad would travel down to West Virginia, he'd come back with all these boxes. And I finally had a nerve to ask the guy, I said, why do you just not get the stuff shipped to your house? He said, well, because if I get it shipped to West Virginia, I don't have to pay sales tax on the item. So people had a big loop around this. Everyone was trying to avoid sales tax. And there's a parallel system. You know, you'll often see sales and use tax, right? So if sales tax is not charged on the point of sale, you're supposed to self-assess the use tax yourself and pay that in. And in fact, if you look on your PA 40, you'll find that there's a line item on there where you're supposed to self-assess use tax and pay it into PA. Just by a show of hands, who puts any number on that line on their PA 40? I put a number on there and it's 0, right? And many of our clients actually this year had got a notice in the mail from places where they purchase items saying, look, we don't necessarily have Nexus in PA, but we wanted to just remind you that you're supposed to pay use tax. And they would send this in, and many of our clients got that this year. So with that sort of as the backdrop, a lot of states said, in particular South Dakota said, you know what, we can't play this game anymore. We can't get to the point where somebody comes selling into our state and our citizens are purchasing a product and they're not self-assessing the use tax. So we're going to write basically our own legislative action that says, hey, we know the old rules were physical presence rules, but we're going to put in these economic rules. And South Dakota started with $100,000 or 200 transactions. So if you were an out-of-state corporation selling into South Dakota, if you met one of those requirements, you were supposed to register with South Dakota and charge those South Dakota citizens sales tax and remit that over to South Dakota. And they said, and South Dakota said, well, the reason why we should be able to do this is because we're losing a ton of money, somewhere between $48 and $58 million a year. And since we don't have a state income tax, this is what goes to pay, and this is near and dear to my heart, the teachers' salaries of South Dakota. This is how we're going to build bridges, pave roads. This is how our general fund is going to be funded. And of course, as everyone knows, this case went all the way up to the Supreme Court, and they actually did side with South Dakota. Now, as many of you know, and I mentioned this last year, the Supreme Court doesn't, first of all, they don't hear a lot of cases in general, and they certainly don't hear a lot of tax cases. So when they take a tax case, everyone's ears perk up. And oddly enough, the oral argument for this case was on April 17th, 2018. So you had all your tax gurus had to go down to Washington, D.C. and argue this. Instead of worrying about filing their 1040, they had to worry about arguing before the Supreme Court. I don't know if that was some sort of poetic justice or not, but nevertheless, they overturned this, right? They overturned this physical presence requirement, and now states are free. It's a wild west, right? They're free to implement their own rules, right? Economic nexus is upon us. So what did Pennsylvania do with respect to this? Just like everything else, they waited forever to get their ducks in a row, but they finally did. And you could see up here, let me just go to the next slide there. They went into effect on July 1st of 2019. Now, I printed out up here, and you can see it on the slide, the economic nexus rules for PA. And they went with the $100,000. But the biggest question I got with respect to, do I have economic nexus in PA is, how do I measure that? Because somebody might call me up and say, well, how do I know if I'm going to sell $100,000 worth of items in this year? Well, PA got smart and said, well, I know you look backwards to your previous calendar year, then effective on July 1, you start to charge that sales tax if you've had more than $100,000 sales in the prior calendar year. Then there was another wrinkle. They said, well, how do we measure this 100,000? Aha, they got smart and said, we're measuring it based upon not only your taxable sales, but your non-taxable sales too. So theoretically, you could have 95,000 of non-taxable sales and $5,000 of taxable sales, and you still had to register, or you still are obligated to register in PA and collect tax on that $5,000 that you're going to sell into the future. I pulled down the rules for the states that surround Pennsylvania. In the interest of time, we're not going to go through all of them, but they're all either effective or coming up to be effective in the short term here. You have Maryland's effective rules are starting October 1st. New Jersey has already been in effect. New York has been in effect. Ohio, PA, West Virginia, they're all in effect right now. So if you're situated somewhere and you're selling into those states, you ought to take a look at those rules, because you might find yourself in a jackpot there where you should be charging sales tax. And you might say, well, why should I do that? Is anybody ever going to catch me? Well, maybe, maybe not. What's the detection risk? It's probably pretty low. But let me tell you where it is going to save you. When you go to sell your business, I guarantee the buyer is going to come in and say, well, what were you doing for the last 5, 10, 15, 20 years in terms of charging sales tax? And now, you may have had a physical presence maybe in 2 or 3 states, and now you've got economic nexus in 35 states, so your exposure just went from $1 million to $15 million because you didn't follow the rules. So what's going to happen in that scenario? They're going to escrow the money, they're going to want you to go back and go through voluntary disclosure, fix all the issues, and you're going to end up paying more money to do that than you would have paid just to become compliant right now. And listen, I understand that this is a major issue for a lot of small businesses. How can I afford to hire somebody to go into all these states and become compliant? And I get it. And there's no real good answer for it other than these are the rules as they are today. The other thing that's come up, and actually PA had just made an announcement about this in the beginning of October. There's a lot of confusion out there right now about what are the nexus rules for sales tax purposes and what are the nexus rules for income tax purposes? And for a long time, the line was pretty blurred. And then when the Wayfair decision was decided, economic nexus really only applied to sales tax. Some states have taken it upon themselves to say, well, no, we think that economic nexus can also apply to income tax. So on October 4th, PA released a bulletin that said, we are now going to the economic presence test for income tax for corporate net income tax purposes. And it'll be presumed that if you have more than $500,000 or more of sales into this state, you have nexus here for C&I purposes. So you're obligated to file a return. And that's the presumption that you do have nexus there. So you have to file the return. Now, of course, all those presumptions are rebuttable. You can still avail yourselves of the 86-272 law, but that won't get you out of filing the return. Still got to file the return and make that election on the return. So I guess next year we'll probably be talking about the same thing, unless the Disney party is in the morning, then I won't be here. So with that, I'll turn it back to you. We only have maybe 1 minute or so.
Yeah, next year we'll be talking about how we're trying to get people out of being in trouble for not collecting sales tax. And remember, we're talking about sales tax. If you're required to collect it, it's not your tax, right? You're just collecting it on behalf of the government. You're an agent of the government. But they take it very seriously. So it doesn't cost you anything other than the administrative costs of coming up with a way to do it. And it's not as simple as looking at the tax law in 50 states. Because in many counties, your sales tax rates are different by county. Ohio is one of those states where sales tax rates are different all over the place. So it's very, very hard to comply. We have seen software companies coming out with software packages that they're selling, say, hey, we know you buy this package for a ridiculous amount of money, then we'll make sure everything gets tracked. So that's all the time we have, unfortunately. I'm telling you, we can do it for 4 or 6 hours. So if you want to stay afterwards, we can do it for 4 or 6 hours. There's a lot to talk about. Unfortunately, we can't talk about everything. But I will say, stay tuned. Next year is going to be very interesting. See where we're going to end up next year. Exactly a year from now, we'll be talking about some interesting things, I'm sure. Thank you very much. I think we have a 15-minute break. Enjoy your break, and we'll see you in 15.